Hi everyone, hello my future accountants. I know you're expecting to see me live today, but as it happens, I have a meeting, so I've just decided to pre-record our discussion for today, especially since we have just all learned that Friday is another holiday, so that might mean that we are also not allowed to have any virtual classes on Friday. So I deemed it best to just record our discussion for the assignment that you have just answered, which basically is the introduction to the introduction to our discussion on the worksheet for merchandising entities. Now, before I start, please allow me to give some disclaimers or some warnings ahead of time. Our neighbor is having some construction done in their house, so you might be hearing some construction noises in the background, and as usual, of course, the dogs. And then lately there have been some kids just running around the place, so might be a bit noisy. I apologize in advance. I hope it won't be too distracting. Alright, so let's now take a look at the problem that you have solved. So at this point, if you do not have a copy of your assignment just yet, particularly the worksheet of your assignment just yet, then I would suggest you hit pause in this video and go ahead and get that assignment for me. All right, but if you have it with you already, very good. So similar with our past interactions as well, when it comes to the assignment, let us together check your assignment for Teresita Buenaflor shoes. Apparently it's not company, my apologies. It's Teresita Buenaflor shoes. Right, there we go. So it's again on page 353 of your book. That's our problem number 23. And basically what we would be checking today would be just the adjusting entries and the worksheet. Now, thank you very much for completely submitting your work via the LMS, which admittedly for the past few days has had some problems, a lot of problems. I shall be manually checking your work in order to give some considerations for changes in format, for example, or differences in format, etc., etc. So for this morning, simply check the adjusting entries as well as the worksheet. So let's start with the adjusting. Let's start first with the unadjusted trial balance. So I decided not to have to go over the entries themselves. I'll be the one to do that manually. But I believe if you got the correct entries, then you would come up with the correct unadjusted trial balance. Okay, so for each of the items we will see in the unadjusted trial balance, please give yourselves one check mark if ever your answer is correct. So of course, our balance for cash is 221,180. So please give yourself one check mark if it is correctly positioned in the debit section. And then 428,000 for accounts receivable, 413,000 for merchandise inventory. And I'd like you to take note that this amount of 413,000 is actually the amount that we get to see in the beginning balance as of February 1, 2020. Okay, because you would then later on see that this represents the beginning inventory. We have yet to account for the ending inventory. Okay, and then we have supplies, of course, at 72,000, and then you have prepaid insurance at 48,000, land at 460,000, building at 1,750,000. And then you will have to the credit side, the first entry is accumulated depreciation building for 350,000, equipment for 2,310,000. Then we have accumulated depreciation equipment, and that's 630,000. Let me just minimize this button right here. And then we have accounts payable, that's 517,000, still on the credit side. We have an account here for salaries payable, but it does not have any balance, so that's a blank for us there. Mortgage payable is 2,600,000. Buenaflor capital is 1,569,000, and then we have the drawings account for under the debit side, that's 400,000. Again, there's still no entry yet on income summary. Sales, we have 1,332,000. Sales returns and allowances, 141,000. Sales discounts, 11,840. Purchases, 668,000. To the credit side, we have purchase returns and allowances 25,000, purchase discount 7,020, transportation in 13,000, salaries expense for 51,000, and then we have transportation out, that's 4,000, advertising expense of 6,000, interest expense of 26,000, and miscellaneous expense of 7,000. So that shall be one check mark for each of the items we have just read out, as well as kindly give yourselves one check mark for the total debit side, that's 7,030,020, provided that there is a single rule before that and a double rule underneath it. And again, another point for another check mark for the credit side, totaling 7,030,020. Again, provide or award only the check mark if there's a single rule above it and a double rule underneath it. All right, so basically this is our unadjusted trial balance. And as I have said, I'll be the one to do the checking for the entries, but if you got the entries correctly, then you must get the unadjusted trial balance correctly as well. Okay, so moving on, let's now try to take a look at the accounts that need adjustments. So basically, in requirement number 3 of our textbook, we are asked to prepare the worksheet using the following information. First information that we have in letter A, salaries in the amount of 51,000 have accrued on February 28. So at this point, we are already given the amount of the accrued salary. So all we will have to do is just match that with the correct account title. And I think you very well know that the entry to this will be debit salaries expense for 51,000 and credit salaries payable for 51,000. So if you got that entry correctly, kindly give yourselves one check mark. All right, letter B, insurance coverage with premiums of 2,000 has expired at month end. Okay, so we have prepaid insurance, as you can very well see here, and we are told based on the additional information that 2,000 of that has already expired. So when an asset expires, this turns into an expense. So the entry for letter B then is debit insurance expense, and then of course credit to prepaid insurance. In letter C, we are told that depreciation on the building and on the equipment for the month amounted to 9,000 and 12,000 respectively. So we have depreciation expense for the building and the equipment, and I have decided to prepare a compound entry for that. Anyway, it's just under letter C. So that's debit depreciation expense, building 9,000, debit depreciation expense, equipment 12,000, then credit the respective accumulated depreciation accounts also for 9,000 and 12,000 respectively. All right, so if you got this entire compound entry correctly, please give yourselves 2 points. But if in case you prepared 2 separate entries for that, one entry for the buildings, for the depreciation of the building, and another one for the depreciation of the equipment, so that will be with 1 check each. So for letter C, again, that's a total of 2 points. And then moving on to letter D, supplies on hand at month end amounted to 14,000. So we have supplies on hand at month end. So if we take a look at our supplies, we basically have a balance of 72,000 and only 14,000 of that remains on hand at month end. So that means that the remaining 58,000 has already been consumed. So to recognize the consumed supplies, we will of course debit supplies expense for 58,000 and credit supplies for another 58,000. So again, if you got that one correctly, that is 1 point. Right? So I hope you're still doing well. I hope everybody's doing okay with regards to the unadjusted trial balance as well as the adjusting entries. There is an additional information there that talks about the count of merchandise inventory at the end of the month amounting to 397,000. So actually, if you went to chapter 8 to take a peek at how the merchandising entities prepare worksheets, then you would notice that merchandising entities have the option of either using the closing entry method or the adjusting entry method. And if you consulted the worksheet presented to you as an illustration on page 360, as illustrated by the author of our book, Mr. Baliada, then you would notice that the particular method used actually as an illustration is the closing entry method. So because that is the illustration used in the book, let us discuss the closing entry method first. The closing entry method simply means that whatever adjustments we need to make to recognize ending inventory will be done in the closing process rather than in the adjustment process. Okay, and of course, just to complete your appreciation for this, maybe in the next video or after this discussion, we shall also take a look at how the adjusting entry method would look like. All right, but for now, since we're using the closing entry method, you would notice we end our adjusting entries up to letter D with the adjustment on supplies. Okay, so let us now try to complete our worksheet after we have determined what the necessary adjusting entries are. Let us complete our worksheet. So I have already opened here the worksheet with the blank money columns so that we could work on it together. So the first adjusting entry refers to salaries expense. So let's try to locate our account title for salaries expense. So that shall be letter A for salaries expense, the amount being 51,000. And subsequently as well, we have to recognize the corresponding credit, which is to salaries payable for the same amount, that's 51,000. Okay, and then for letter B, we have a debit to insurance expense. Let's try to find insurance expense, and it's right about here. So that's letter B. Insurance expense was debited for the amount of 2,000. And of course, there's a corresponding credit to prepaid insurance. So the credit side's here, this is letter B, and the amount is 2,000. Of course, the way you did your assignment is more interesting because you did it manually. So, but I hope you're still able to follow the process, even if this time we're doing it in Excel. Okay, how I would have loved if every one of us had access to MS Excel at home. But again, we have to be considerate of those nga walay access sa Excel. So moving on to letter C, we have depreciation expense building. So our account title for that is right about here. And the amount is, of course, 9,000. And then we also have depreciation expense for the equipment. And that's about 12,000. And of course, the corresponding credits to that will be accumulated depreciation building, which is 9,000, and accumulated depreciation equipment, which will now have an additional 12,000. And then after which, we have to recognize supplies expense. Let me find supplies expense first. So that's letter D, and supplies expense is 58,000. And then of course we have supplies. All right. So that completes our adjustments. Again, please remember, under the closing entry method, the recognition of the ending inventory happens in the closing process. So it does not appear in any of our adjusting entries. And so therefore, we only have 4 adjustments. And so if we are going to determine whether this is in balance or not, sorry about that. Okay, totally forgot the columns don't have the same size. I'll just delete that for you. There we go. So that's 132,000. Okay, the total of the debits would equal the total of the credits. So yay! Please give yourselves 1 check mark for each of the correctly posted adjustments under the adjustment column. So 58, that's 1 check, 2,000, another check, and of course 1 check mark for each of these. And then later on, of course, 1 check mark for the final totals, provided again that it has been single ruled and double ruled. Alright, so now that we have correctly posted our adjustments, it is now time for us to fill up the section on the adjusted trial balance. So we all know how this works. We either extend or we cross-foot. So in the case of cash, since there is no adjustment, so we basically just extend cash. The same is true as well for accounts receivable. And again, because we are using the closing entry method, no adjustment has yet been made to merchandise inventory. So basically, we're just extending those amounts. And then we hit our first account with an adjustment, but notice that supplies having an original debit balance is credited for 58,000. So that's 72 less 58, you get 14,000, which is the amount of supplies in hand. Prepaid insurance, of course, having a debit balance, has a credit adjustment of 2,000, so that will be a deduction. Land has no adjustment, so therefore that will be an extension. Building has no adjustment, so another extension. In the case of accumulated depreciation building, we have a credit beginning balance of 350 and a credit adjustment. So credit and credit means addition. And then no adjustment for equipment, so another extension. And then an adjusted balance for cumulative depreciation equipment. The first one was building. Okay. And then of course we have accounts payable, no adjustment, so just an extension. Salaries payable has a 0 beginning balance and it was credited for 51, so it now has 51,000 adjusted balance. No adjustment for mortgage, no adjustment for capital. There is also no adjustment for the drawings. You just have to be careful about extending it to either debit or credit. Okay, and of course we know income summary has no adjustment as well. It doesn't even have an entry yet because it only comes out during the closing process. And then we have sales, it's a credit. And then extend our contra sales account, that would be your sales returns, discounts, and allowances. And then of course we have purchases, which also does not have any adjustment, so it's on the debit side. And then we have purchase returns and allowances together with purchase discounts, both extended to the credit side. And then we have transportation in. So for transportation in, an extension to the debit side. Salaries expense had an unadjusted balance of 51, but then we debited it for 51,000 as adjustment letter A, so we now have an adjusted balance of 102,000. So that's debit and debit, so addition. Supplies expense, 0 beginning balance plus the debit side of 58. Insurance expense, 0 beginning balance plus the debit side of 2,000. Same is true with depreciation. The two depreciation expense accounts that we have, transportation out is extended to the debit side. Same is true as well with advertising, interest expense, and miscellaneous expense. Okay, so we have just completed our adjusted trial balance, and so therefore let us take a look if this indeed is in balance. All right, there we go. 7,102,020. So again, for every item you will find here, please give yourselves 1 point. So for each of the amounts you will find in the adjusted trial balance, yes, daghan kitag points ani class no ma-earn from the worksheet. So 1 check mark for each, all the way down to the final total debits and the total credits, provided again that there is a single rule before it and a double rule underneath it. Okay, so that is now our adjusted trial balance. And so now comes the part where we fill in the income statement and the balance sheet. Okay, so what do we need to remember when we fill out the income statement and the balance sheet? Well, income statement would include all of your nominal accounts, okay, except the drawings. So nominal accounts would include, of course, revenues and expenses. The balance sheet, on the other hand, would include all the real accounts, assets, liabilities, equity, including the drawings. Okay, so in order for us to properly fill out these amounts, let us start with cash. And we know that cash is an asset, so it will be extended to the balance sheet. Again, we focus our attention on the adjusted trial balance section, so we extend 221,180 to the balance sheet. Same is true with accounts receivable. Now here comes the part on merchandise inventory. So how do we deal with merchandise inventory? So we are using the closing entry method. According to additional information letter E, additional information letter E says account of the merchandise inventory on February 28. So the trial balance given to us is February 1. So therefore the 413,000 that we have here represents the beginning inventory. But the 397,000 that is given in additional information letter E as the result of the actual physical count represents the ending inventory. Okay, so remember that the ending inventory is the actual inventory on hand at the end of the period. And so therefore the actual inventory on hand is your asset, right? It's an asset. It's unsold merchandise. And so therefore, as of February 28, 2020, which is the date that we are preparing this worksheet for, then we should have merchandise inventory at the ending amount. Okay, and the ending amount, as we have already determined based on the additional information, is 397,000. Okay, so ending inventory will appear on the debit section of the balance sheet. Now, let's deal with the beginning inventory. What's going to happen to the beginning inventory? Okay, so bring yourselves to imagine February 1, because basically this is the February 1 balances. So bring yourselves to imagine February 1. So when you're standing on February 1, you get to see 413,000 of beginning inventory. Now the expectation is that this 413,000 will be sold within the month. Okay, if you could perhaps imagine first in first out, no, the inventory that you have, the beginning inventory that you have will be sold first. So parang inana ang iyahang pag-imagine niya, no? So kanang 413,000 nimo, that would have already been sold during the month. And so therefore, because it is already sold, then it would have been part of cost of sales. Right, so that is why we will extend it to the debit section of the income statement. But then remember that your beginning inventory, which is right about here on the debit section, is also where you will find the purchases. Let me just extend the purchases first so you would get to see what I mean. And you know, the purchases family, including its contra accounts then, and its adjunct account. So what you would see here is this is actually now, you will find here the formula actually for goods available for sale, wherein you will have your beginning inventory plus your net cost of purchases or your net purchases. So beginning inventory will go together with purchases, because that's how you compute for goods available for sale. And if you remembered how to compute for cost of goods sold, that is actually goods available for sale less ending inventory. So since we say less ending inventory, then that should mean that the ending inventory will appear on the opposite side, the opposite balance. So ending inventory of 397,000 will appear on the credit side of the income statement. So you might be wondering, what are the inventory accounts doing in the income statement? So the inventory accounts appear in the income statement in order to reflect our computation for the cost of goods sold. Right? So we have your beginning inventory plus purchases, less purchase returns and allowances, less purchase discounts, plus transportation in, less ending inventory. So that is the reason why it appears on the debit side. The beginning inventory appears on the debit side to recognize that it will be sold during the period, and the ending inventory appears on the credit side to recognize that not everything was actually sold during the period. And it will also appear under the debit side of the balance sheet to recognize the unsold merchandise as of the end of the period. All right, so this one right here is something that you would like to take very good note of, and take note again that we are using the closing entry method for this. And this is exactly how Mr. Balyada illustrated it in our textbook in chapter 8 of your book. All right, so let us proceed now to extending supplies, because we know that's an asset. Of course, we paid insurance as well, and then we have land, and then we have building, and then the contra account for building, and then we have equipment, and of course the contra account for equipment, and then we have accounts payable, and then we have salaries payable. We of course have mortgage payable, which is a non-current liability. Then we have the capital account, and then we have the drawing account, which is of course a debit. Okay, then afterwards we are going to start extending to the income statement columns. So we have sales, and then we have sales returns, sales discounts. Of course, we've already extended purchases and purchase returns and transportation in when we illustrated it a while back. And then we have salaries expense, supplies expense, actually all of the expenses now at this point, right? So just extend those from the adjusted sorry, trial balance columns. All right, there we go. So we have now fully extended everything that needs to be extended to either the income statement or the balance sheet columns. Let's draw a single line to that, and let's try to get the balances. I think you very well know already, similar to the service entities or the service concern, this is expected not to balance because we are expecting to see income and expense. Income and expense, profit or loss, or net income or net loss. So let us now analyze the section on the income statement. So to analyze the income statement sections, the credit side is greater than the debit side. That means revenues are greater than expenses. So of course, this will represent net profit. Okay. Net profit or net income will be the same. Alright, so let me just minimize this right here. And we know that we cannot use negative signs in our worksheet, so therefore it has to appear on the side with the lower balance. So this is our net profit of 288,180. I'm just putting it in bold font to better, show you the amount, but that's not the case if you're doing it manually. All right, you don't have to okay. And then of course, under the balance sheet, you would notice that the debit side is greater than the credit side, and so therefore our entry should be found under the credit section. This will also our net profit or net income will also be found on the credit section. This is in cognizance of what we say, that net profit or net income increases the capital account. Right? And so because we have already determined the amount of net income, let us now try to get the balances. There we go. Okay, there you have it. So all of our debit sides and credit sides should now be neatly imbalanced, all of them. Okay, so what we are going to do then, with the worksheet that you have with you right now, for each item that we have here, please give yourselves 1 check mark. Anyway, this is an assignment, so it will be an equal 1 check mark for all the amounts that you see. But had this been a quiz, then you would know that I'll be giving more points for the net income or net profit. No? But this is an assignment, so an equal 1 point for each of these correctly extended amounts to the income statement and the balance sheet. Again, if this were a quiz as well, I might give additional points for this. No? But for now, 1 point each like that. Okay, so here are the amounts. Feel free to hit pause on the video if you still have to check your work. Okay, and I'll just show the other half now. Okay, starting with purchases and onwards. Don't forget 1 check mark for each of these. Please make sure that the proper use of the single rule and the double rule is observed. All right, just feel free to hit pause on the video if you still need more time to check your work. Okay, so this is now what we call the closing entry method. Okay, let us complete the closing entry method by preparing the closing entries. I know that the next step for this will be for you to prepare the financial statements. No, I mean, of course, to journalize and post the adjusting entries and to prepare the financial statements. So let's just suppose that the financial statements have already been prepared. In order to fully appreciate the beauty of the closing entry method, let us now prepare the closing entries. Okay, let us now prepare the closing entries. So the key here is to take a look at your income statement accounts. Okay, you just hold the income statement figures right about here. So the idea is for us to close all the credit balances and all the debit balances under the income statement account first, right? So let us start by taking a look at closing all the credit balances. So I'm going to highlight it right here just so that we would be guided. Okay. So the first step we're going to do is to close these right here. So you would notice that the first item you would see there is merchandise inventory. So actually, when we close merchandise inventory, because we are debiting it, if you can imagine the T account, you are actually recognizing merchandise inventory, diba? When we debit an asset, we're actually increasing the asset. So you would notice now when we perform our closing entries and we debit merchandise inventory, the action, this particular entry actually has the effect of increasing or recognizing our ending inventory. So that is the amount 397,000. And then we also have sales. So we are also going to close sales. Remember, all credits will be debited. So we have 1,232,000. And we will find here as well our purchase returns and allowances. So that's a credit side on our worksheet. So we're going to debit that here. And then of course, our purchase discounts. Okay, here we go. And no other credit accounts under the income statement columns already. And of course, we shan't forget that the partner for this will be income summary. Okay, so we're just going to total all of this. And so that is our first closing entry. Now, this is not part of the requirements in your book, I think. Let me just check very quickly. I don't think it's part of the requirements. Oh, yeah. We do have prepared the closing entries. Okay, so this is part of the requirement. So please give yourselves one check mark for this entire entry. Okay, just one check mark lang. Like I said, anyway, it's the assignment. And you could also interchange A and B. So you could start with closing the debit columns. That's not a problem. So since we have already closed the credit section of our income statement, let's now go ahead and close the debit section, okay, or the debit side. So because these are all found in the debit, then we will have to credit these. So the partner then, because we're going to credit everything we see in the debit section, so the debit income summary. Okay, there you go. So we have income summary, and then we're simply going to credit all the debits. Let me just fast track this a bit, I think. Hopefully this one will work. There we go. Let's see. Try to see if this one works. All right, there we go. Oh, sorry. Okay, there we have it. So all of our accounts then under the debit section, starting with sales returns and allowances, all the way down to miscellaneous expenses, will have to be credited so that they will be closed. Okay, so I'm just gonna put that right here and then just, take care of the formatting a bit. Now, we shan't forget that there is also this one right here. So although traditionally under the service entities, we know that the debit side would represent the expenses, but let us not forget that there is a merchandise inventory account right there. So we're also going to credit merchandise inventory. And the amount is, of course, 413,000. So if you can imagine the T account for merchandise inventory, let me just draw that for you very, very quickly. Okay, and then just, remove it afterwards as well. But I just want you to picture out what happens to merchandise inventory, the T account. So I've drawn for you the T account for merchandise inventory so that you'd be able to see lang what happens. So if you remembered, it started with a beginning balance of 413,000. It's right about here in the unadjusted. And then when we prepared the adjusting entries, we did not consider merchandise inventory, so yay, no movement. But when we made the closing entries, we debited merchandise inventory right about here. So debit merchandise inventory. And then we credited merchandise inventory right about here. So credit merchandise inventory. So if you're going to compute for the balance of merchandise inventory, quite obviously this will already be zeroed out, and the only balance left is 397,000, which is our ending inventory balance. So everything is right with the world now. The T account will then show the correct ending inventory balance. Alright, so let's just remove that. It was just for purposes of, illustration. and move on to assigning a debit amount, not assigning, computing a debit amount for the income summary for our second entry. And of course, that should be 1,472,840. And perhaps at this point, you could already choose to close the income summary account, right? Close the income summary account at this point. Just check where this is moving. Okay, there we go. So notice that if you take a look at the T account for income summary, again, let me just open that for you very quickly, right about here. Okay, just so you can picture it out. It would be very helpful really to analyze using the T accounts, even when you go to higher accounting. So I hope you won't forget that. Okay, so how to analyze using the T accounts. So you have here the T account for income summary. The first entry that was made to it was when we credited it in letter A. So I'm just going to post it right here. And the second entry that we made was when we debited it in letter B. So I'm going to post it right here. So you would notice that income summary, let's try to check how much is its balance. The credit side is larger than the debit side, and so therefore this should be 288,180, which is the amount of our net income. Okay, so because the income summary has a larger credit side, so we shall close it by debiting income summary. Okay, so we shall debit income summary, and of course the amount is the amount of our net income, 288,180, and the credit is Venaflor Capital. There we go, 288,180. Okay, that is our adjusting entry. And when we do this entry, and if you post this here, then ma-zero out na siya, right? Okay, wala na siya. So, mo-balance na siya. It will be the same amount and mo-zero out na siya. Okay? So, I mean, do I need to show that yet? I don't know. I don't know if I should. Let me just, yeah, I better. Okay, I can't assume that everybody was able to get that. I'm so sorry. So if we post this to the T account, then you would notice that our T account for income summary would already be 0, because it will have a total debit of 1,761,020 and a total credit of the same amount. Okay, so that's why we need to make this closing entry. All right, let's now proceed to the fourth closing entry. And the fourth closing entry is the drawing account. So let's close the drawing account. The drawing account has a debit balance, so to close it, we will have to credit it. And drawings have the impact of reducing capital. So to reduce or decrease capital, we of course debit capital, and then we credit the drawing account, which is Venaflor withdrawals, and the amount, of course, is going to the balance sheet. The amount for the drawings is 400,000. There we go. So after posting all of your closing entries, if we posted all of the closing entries correctly, let's just take a look at what happens to the capital account. Okay, this is Venaflor Capital. Right about here, we post. It has a beginning balance, which is a credit. A beginning balance unadjusted, the capital account. Where are you? Here you go. 1,569,000, and then in our closing entries, we credited capital for the amount of the income, 288,180, and we debited it for the amount of the drawings, 400,000. So if we try to take a look at the adjusted capital balance after the closing entries, this will be your closing ending capital balance. So you would notice that the credit side is of course larger than the debit side, and so therefore our balance for the capital account adjusted, after the closing entries, would be 1,457,180. So if you prepared a statement of changes in equity, which I think is also part of your requirement, then it should show your ending balance of that amount. And this amount will be the amount that will appear in the balance sheet, okay, when we prepare one later on. Okay, so there you go. I'm just going to again remove this. Anyway, you could always like hit rewind if you want to see it again, but I'll remove that because it's not part of the closing entries. So for each of the closing entries, give yourselves 1 point if you got each correctly. Pwede ra siya magka-interchange, I don't mind. Okay, there. So that is the closing entry method. The closing entry method simply means that the recognition, okay, take note of the term, the technical terms, the recognition of ending inventory and the de-recognition. Muna siya yung mga accounting terms na to, no? To de-recognize. So the recognition of ending inventory and the de-recognition of beginning inventory happens in the closing process. Alright, so up next, we are going to talk about the worksheet. This time, we're going to illustrate it using the adjusting entry method. Okay, so I'll just cut the video right here for now. It's quite lengthy already. Please comment your scores in the post where this video, in the Facebook post where the link to this video is found. Okay, so thank you very much, and I'll see you in the next video, which is going to talk about the adjusting entry method.